Welcome to Capital Link's company presentation series.
Welcome back to the 2026 Capital Link corporate presentation series. I am Paul Lamputis at Capital Link. As a reminder, in this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We are pleased to welcome today the senior management team of EuroDry, Mr. Anastasios Aslidis, Chief Financial Officer and Treasurer, and Mr. Simos Pariaros, Chief Administrative Officer. EuroDry was formed in 2018 as a spin-off of Euroseas and operates drybulk carriers that transport major bulks such as iron ore, coal and grains, and minor bulks such as bauxite, phosphate, and fertilizers. Following the delivery of 2 newbuilding vessels in 2027, the fleet will expand to 13 vessels with a total capacity of approximately 893,000 deadweight tons. EuroDry trades on the NASDAQ Capital Market under the ticker symbol EDRY. In terms of logistics, we would like to remind our viewers, we begin with a company presentation followed by a live Q&A. Please note that participants can submit their questions through the Q&A button on your screen during the webinar. Your questions will be answered during the Q&A session. Before we begin our webinar, kindly note that this discussion is strictly for informational and educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for the content. Let us now begin with our discussion. I'd like now to pass the floor to Mr. Anastasios Aslidis. Please go ahead, sir. Welcome back to the 2026 Capital Link corporate presentation series. I am Paul Lamputis at Capital Link. As a reminder, in this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We are pleased to welcome today the senior management team of EuroDry. Joining us today is Mr. Anastasios Aslidis, Chief Financial Officer and Treasurer, and Mr. Simos Pariaros, Chief Administrative Officer. EuroDry was formed in 2018 as a spin-off of Euroseas and operates drybulk carriers that transport major bulks such as iron ore, coal, and grains, and minor bulks such as bauxite, phosphate, and fertilizers. Following the delivery of 2 newbuilding vessels in 2027, the fleet will expand to 13 vessels with a total carrying capacity of approximately 893,000 DWT. EuroDry trades on the NASDAQ Capital Market under the ticker symbol EDRY. In terms of logistics, we would like to remind our viewers, we begin with the company presentation followed by a live Q&A. Please note that participants can submit their questions through the Q&A button on your screen during the webinar. Your questions will be answered during the Q&A session. As a reminder, once again, before we begin our webinar, kindly note that this discussion is strictly for informational and educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for the content. Let us now begin with our discussion. I'd like to pass the floor to Mr. Anastasios Aslidis. Please go ahead, sir. Welcome back to the 2026 Capital Link corporate presentation series. I am Paul Lamputis at Capital Link. As a reminder, in this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We are pleased to welcome today the senior management team of EuroDry. Joining us today is Dr. Anastasios Aslidis, Chief Financial Officer and Treasurer, and Mr. Simos Pariaros, Chief Administrative Officer. EuroDry was formed in 2018 as a spin-off of Euroseas and operates dry bulk carriers that transport major bulks such as iron ore, coal, and grains, and minor bulks such as bauxite, phosphate, and fertilizers. Following the delivery of 2 new building vessels in 2027, the fleet will expand to 13 vessels with a total carrying capacity of approximately 893,000 deadweight tons. EuroDry trades on the NASDAQ Capital Market under the ticker symbol EDRY. In terms of logistics, we would like to remind our viewers we can begin with a company presentation followed by a live Q&A. Please note that participants can submit their questions through the Q&A button on your screen during the webinar. These questions will be answered during the Q&A session. Before we begin our webinar, kindly note that this discussion is strictly for informational and educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for the content. Let us now begin with our discussion. I'd like to pass the floor to Dr. Anastasios Aslidis. Please go ahead, sir. Welcome back to the 2026 Capital Link Corporate Presentation Series. I am Paul Lampudis at Capital Link. As a reminder, in this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We are pleased to welcome today the senior management team of EuroDry. Joining us today is Dr. Anastasios Aslidis, Chief Financial Officer and Treasurer, Mr. Simos Pariaros, Chief Administrative Officer. EuroDry was formed in 2018 as a spin-off of Euroseas and operates dry bulk carriers that transport major bulks such as iron ore, coal, and grains, and minor bulks such as bauxite, phosphate, and fertilizers. Following the delivery of 2 new building vessels in 2027, the fleet will expand to 13 vessels with a total carrying capacity of 893,000 DWT. EuroDry trades on the NASDAQ Capital Market under the ticker symbol EDRY. In terms of logistics, we would like to remind our viewers, we begin with a company presentation followed by a live Q&A. Please note that participants can submit their questions through the Q&A button on your screen during the webinar. Your questions will be answered during the Q&A session. As a reminder, before we begin our webinar, kindly note that this discussion is strictly for informational and educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for the content. Let us now begin with our discussion. I'd like now to pass the floor over to Dr. Anastasios Aslidis. Please go ahead, sir.
Thank you, Paul. Thanks, Capital Link, for organizing this series and inviting us for one more year to participate. I will be glad to give you some overview of our company, EuroDry. But before I start, let me flash on the screen for a couple of seconds the forward-looking statements slide. As you know, we are going to be doing some forward-looking statements regarding the market and prospects for the company. So that's why we're flashing this slide for you to be aware of that. As Paul mentioned, EuroDry owns dry bulk ships. We own currently 11 vessels, and we have placed orders to build 2 more, which we're going to take delivery in 2027. Our fleet carries, again, as Paul mentioned, dry commodities in bulk like iron ore, coal, grains, and minor bulks. And we are focusing in the middle of the size range of dry bulk carriers from 50 to 85,000 deadweight tons. These vessels typically are called Ultramax on the low end to Kamsarmax on the high end. And we are doing that because we believe that this size range provides us the most flexible employment opportunities. EuroDry indeed was in the past part of Euroseas, a company that was formed in 2005 and entered the public markets on NASDAQ in 2007. 8 years ago now, we felt that it was better for our shareholders to separate from Euroseas the container fleet and the dry bulk fleet. Euroseas at the time had both types of ships. In doing so, we released at the time significant value for our shareholders, at the time having pure plays in the market, and I believe still today, was the preferred way of investing in shipping by investors. We pride ourselves on having a long tradition in shipping. The family of our CEO dates its roots back into the 19th century, 2 centuries ago. The current management of the company, in terms of the family of our CEO, Aslidis, is the fourth generation, with the fifth coming in. The rest of our management team, myself, Simos, who's on the call, and all of our board members are by now veterans in the industry, and all our board members hold leading positions in their respective fields and have long investment experience in shipping. We do manage our vessels ourselves through two affiliate companies, which are affiliated to the family of our CEO, EuroBulk and EuroBulk Far East. Having these two companies in the two opposite ends of the world provides us significant flexibility in managing our vessels. EuroBulk has a 30-year-long history. EuroBulk Far East is the most recent company. It has only 10 years history, which by now is significant itself. Because of that involvement, we are well established in the sector, both in Greece and worldwide, and we're well respected by our counterparties, those being charterers, suppliers, bankers, and all the other industry participants. As we mentioned, we own a fleet of 11 vessels and 2 new buildings. We tend to think of our fleet in terms of clusters. We have, as you can see here in the slide, 2 clusters. Our modern cluster, which consists of 8 vessels, 6 Ultramaxes and 2 Kamsarmaxes. Of those 8 vessels, 3 were built by ourselves by placing orders in the yards, and the rest were bought and are they are typically sister ships of the ones we built. Then we have our Panamax cluster, which currently has 3 vessels. These vessels are a bit older. They're above 20 years of age by now, but they are very good quality. When they were built, they were the workhorses of the industry. In addition to the existing fleet, we've been trying to keep modernizing our fleet, and we have placed orders for 2 Ultramax carriers, which we expect to take delivery in 2027. And this really consists of our growth strategy. We want to turn EuroDry into a modern dry bulk shipping company owning a growing number of vessels. Our challenge is to renew our fleet and grow it. And we have started that renewal by replacing what we call our Panamax cluster with newer vessels. In the beginning of last year, we had 5 vessels in our Panama cluster, and during 2025, we sold 2 of those, and we reinvested the proceeds into the new buildings. We can grow by generating funds through our operations. I have to admit that it has been relatively difficult during 2025 to do so because the market was not very strong. We can do that thus organically, as I say here, potentially issuing new shares and raising funds, but that option for the time being is not practical because we trade, as I will discuss later on, at a significant discount to what we believe is our intrinsic value, and we don't want to dilute our shareholders. Or we can expand by cooperating with others, co-investing with others. An example of this type of investment was an acquisition of 2 vessels that we did about a year and a half ago, that we bought them jointly with other investors who were investors not in EuroDry, but they were investors in the vessels that we acquired. This definitely provides us a way to grow our fleet and our presence in the market. Before talking a bit about the employment of the vessels and our strategy and our plans, let me give you some remarks about what we see in the marketplace. This chart captures what we believe has been, and I think still is, the investment thesis for dry bulk shipping. You can see two lines on this chart. The first one, the red one, shows how many vessels are on order as a percentage of the existing fleet. You can see the horizon here is the last 20 years, and you can see that since 2020, the number of ships that are on order as a percentage of the fleet has been hovering in the low end of that 20-year period. That means that the fleet is not expanding as much, has not been expanding as much, aging at the same time, and that creates an opportunity for any growth in demand to be translated to better rates and prices for owners. You can see and appreciate that back in 2008 and 2009, this number that is currently 12.5% and was as low as 8% 4 years ago, was nearly 80%. It was a huge burden and a huge backlog of ships for the industry to absorb back then, and a much lower burden, in fact not a burden at all, to absorb and put into operation the existing number of ships under construction. In parallel, in this chart, you can see the earnings of a Panamax size vessel, and you can see the wild swings that we had over the last 20 years. Just before the financial crisis, the markets were doing extremely well, with rates being about $70,000 and $80,000 a day. That picture changed dramatically after the financial crisis. And then, for reasons that I will not get into, the market had stayed in a pretty miserable, if you allow me to say, state all the way until COVID hit, when we saw an increase in rates in 2021 and 22. And then again, we have been dragging along around $13,000 a day, while now we have seen some recovery of the market, and we expect to see some more, as I will discuss, and with the current rates for Panamax vessels being around $15,000 a day. So we have not been enjoying a good market for the last 3 or 4 years. At the same time, we are building the premise for a recovery because of the low order book. This is the message of this slide. A similar slide providing long history. This shows how prices have moved both in new building and second-hand prices. And you can see here in terms of the second-hand prices that we have been trading recently just above the historical median of that 20-year period. A little more detail on the fleet development. I will not stay long for this slide. I think the essence was what I showed you earlier, but you can see on the bottom left of this slide the age profile of the fleet that has a good number of vessels above 15 years of age. About almost 30% of the fleet is above 15 years of age. This depends on the market, of course. This could provide, in terms of low markets, a bucket of ships that could withdraw and leave operations, either because they cannot meet new environmental regulations or because it's not economical to work. And you can see that the percentage of ships that are older is larger for the sizes we operate, the two middle-sized classes. The larger ships, what we call the Cape-size ships, have a younger fleet profile, while Panamaxes and especially Handymax and Supramaxes have an older fleet profile, and that could blend well with the low supply, with the low order book for those segments as well. And having spoken a bit about supply, it's important to speak also about demand for dry bulk shipping. This slide shows and presents a broad correlation between demand for dry bulks transportation and the world economic growth. Again, without getting into the strength of a statistical correlation, visually one can see then when the world economies have been doing well, especially the developing world economies, that they need raw material to develop, then the dry bulk market, demand for dry bulk trade has done well. And there are two ways to describe dry bulk trade. One is the actual amount of tons that are carried. That is very important, of course. The other aspect of dry bulk trade is the distance over which those tons need to be carried, and what we call the ton-mile demand. Clearly, what is the most relevant measure for demand for shipping is the ton-mile demand, because the larger distances that commodities that need to be transported are transported, the more ships are required. So we have to look at factors that affect the trade pattern as well, in addition to the trade demand directly. And there have been interesting developments in the past several years that could be considered exogenous to the drivers of demand. For example, when the Panama Canal closed 2.5 years ago because of the shortage of fresh water, that created long waiting times and blocked ships from trading freely, and was a boost in demand. The same happened last year with the Suez Canal, when, because of the attacks by the Houthi rebels there on shipping companies diverted their routes around Africa, lengthening the hauls and creating more demand for shipping. Other factors that affect the pattern of trade and the demand for shipping have to do with the rules that are imposed on the ships themselves. For example, the recent environmental regulations about CO2 emissions to be met could be met by slowing down vessels. So the effective speed restrictions, so to speak, or slow steaming, as we say, create more demand for ships, because a vessel can take longer to make a certain transport of a cargo. So more ships are needed. So all of these come into play and create and form the demand backdrop for shipping services. My presentation would be not complete if I don't give you some highlights about the various commodities that are traded and the trends that leading analysts are seeing in those commodities. This is borrowed by Clarksons, the leading shipbroker in shipping, and basically lists the major commodities that are being serviced by dry bulk ships: iron ore, coal, grain, steel products, bauxite trades that are becoming more important lately, and all other trades, we call them minor bulk trades. Different size of ships do some of these commodities. For example, the very big ships predominantly do iron ore trades and bauxite trades, the Capesize ships. Our ships can do pretty much everything here, except perhaps some of the minor bulk trades, which move in smaller loads. But looking at this and sort of putting some attention on the arrows on the right part of the slide, we can see that certain commodities like iron ore have some upward trends, and I'll elaborate a little more on the next slide on this. Other commodities like coal are expected to be on a downward trend, and that was really because of the net zero drive, which has been partly deflected by the policies that the new US president is trying to put, and the refocusing on the fossil fuels. But still, overall, a downtrend is expected for the coal trades. Grain trades, again, are expected to see positive trends. The same with bauxite trades, significant trends, and the other minor bulk trades, with overall trade being modestly upwards over the next 2 years. You can see at the bottom here the summary growth percentages, and this is in tons. We have to take, as I mentioned, into account ton miles. But really, I want to point out in this slide and elaborate a little more, a big part of the of demand for dry bulk shipping comes from the steel industry, which involves the iron ore trade, a big part of the coal trade, the metallurgical coal trade, which is not declining, the steam coal trade, the thermal coal trade is the one declining, and the steel products. All these taken together exceed 40% of the overall demand. So the steel industry is an important factor in the dry bulk trades. That's a point that I want to make in this slide. And really, in the steel industry, the driving force is China. I'll go to the next slide where I show you a breakdown of the trades by importer for iron ore and coal, and this is both coals together, so it's a little bit of a blurry picture, but on the iron ore trades, in every region of the world, we see positive trends looking forward. At least Clarksons sees positive trends looking forward. China is a big question, and China indeed does make a big part of the iron ore trade. The same information is shown on the bottom for the coal trades. There you can see that in most regions of the world, because of the efforts to decarbonize and move away from using coal as energy production, we expect to see downward trends, but that doesn't mean that we will see them. There are certain short-term things and substitution of sources of coal that could create demand for shipping, while the overall trend might be downwards. So to try to sum up what we see on the dry bulk market and then return to discussing a bit about EuroDry, we saw that in 2025, the first bullet I have there, the market was not very good for the first 6 months. It started improving during summer. In the fourth quarter, it was relatively satisfactory and continues to be satisfactory now, although weakened a bit, but it's a normal seasonal weakening. We see trends of the market becoming stronger later in this quarter into the second quarter, partly for seasonal reasons, but also partly for certain developments. And that is the point we're trying to make in the second set of bullets here, where for one thing, there are certain big projects that could create demand for iron ore and boost iron ore production and trade. If capes, the larger ships, do well, they tend to drag all the ships' sizes into better rates. But there are also specific other factors that could provide and support demand for both for capes and for other ships. The bauxite trade is an emerging trade, especially from West Africa into China, but also Chinese imports of US soybeans. And there are also other factors that could come and create an uncertain picture, like what's going to happen in the Red Sea and the Suez Canal crossings. On the supply side, we discussed it. I will not repeat it. We have low supply growth. We have environmental regulations coming in, putting pressure on older vessels to retire. And all of this could help provide the foundation for a good market if demand and other geopolitical factors that could affect it come through in a positive way. Let's now return and I'll give you some highlights for how we employ our ships, what is the outlook for our earnings, qualitatively speaking. And let's start by looking at our employment chart. This shows how our ships were employed in 2026, 2025, the second half, and how their employment commitments are in the first half of this year. And you can see that by and large, all of our ships are on short-term charters or on index-linked charters. These are charters, although they run for long periods, the rates of them are linked to market indices. So really, our fleet is exposed to the market. We have only 1 or 2 ships that are booked for medium length periods. So our positioning here is to be flexible and wait for the market to recover to be able to exploit it. And as we see the market to provide us with higher rates for longer periods, we will start fixing some of our ships for longer periods. That's our chartering strategy. In terms of financial results, I mentioned already that 2025 has been a difficult year, both 2025 and 2024. And the bottom part of this slide shows the high correlation of our earnings to the market levels because of the strategy that we follow, that we have, we employ our vessels on short-term charters and index-linked charters. So as we have seen the market to be better in the fourth quarter of last year, we expect to see our results to be better in the fourth quarter of 2025, where in fact we expect to have to turn the corner and move into a positive territory. And this is sort of what was the average rates that we saw in the market were significantly higher for what were the first 9 months of the year, and we expect to see, we'll announce it in about 3 weeks, 4 weeks, the results, but we expect to see positive earnings for the fourth quarter because simply the market did well. And the same thing for 2026, I dare to say, based on what we know now, using the forward market, we expect to see levels that are above our earnings break even. So hopefully that would translate to a profitable year for us as well. Some further highlights from our financials. On the top part, I show you our debt situation and how the debt levels we have compared to the market value for our fleet. We have a relatively low leverage ratio. We carry a debt as of the end of December. I moved the time a little forward here to the end of the year. We have 104 million of debt, which represents about less than 50% leverage, which is pretty good and pretty safe, I would say, for a shipping company. And on the bottom, what is important to see is that we have, for the next 12 months, a break-even level, a cash flow break-even level of just below $12,000, which, if you remember, the forward rate for 2026 that the FFA market was showing was about $15,000. So that alone gives you an indication that we should be looking at a profitable year if these trends, if these levels are maintained. I'm about almost through with my remarks. Just a quick look at our balance sheet in a sort of simplistic way. A shipping company's balance sheet is very simple. On the asset side, it has vessels and cash. On the liability side, it has basically debt and some short-term liabilities. Taking all this into account, we figure that we have a book value that is about 200 million. So book value of our assets, 200 million. And we have liabilities of about 105 million taken overall. So we have a book value of shareholders' equity of about 90 million or almost $32 per share. We trade as of yesterday at around $13.50 per share. So a significant discount to our book value. But it doesn't stop there. The market value of our fleet is higher than our book value. So if we look back at the last date that we issued results, September, we had a market value for our fleet that we estimate, but it's very easy to estimate values for dry bulk vessels. It was 38 million more than its respective book value. So we had a value for our fleet of about $45 while trading at 13. So that gives you a sense of the potential that is hidden under the EuroDry stock. Let me wrap up my presentation, and I have taken a lot more time than I planned to, by giving you a couple of reasons why it would make sense for an investor to look and invest in EuroDry. There are two main reasons. There is an industry thesis coming from the supply side, which would allow a slow growth of the supply side, will allow any growth in demand to be translated to better market rates. And real growth in demand will come primarily from China and the steel industry. So a bet on the dry bulk industry, but dry bulk sector, is a bet on China returning to a healthier economy. That is one of the reasons, and the other reason is company specific. As I mentioned in the previous slide, we traded around $13 and we're worth about 45. So we traded a significant discount to NAV, and at some point that would reverse. As Warren Buffett says, when a tide lifts all boats, it will lift our boat more than any other boat that is out there. And there is a number of other reasons that we take pride of, that we focus on a flexible size range of ships. We can find continuous employment for our vessel, take advantage of market trends. We run a cost-efficient operation here. We have an experienced management team, as I mentioned, and we have a platform. That was the original idea of spinning off EuroDry, to create a platform to consolidate other fleets, a public platform. We haven't managed to deliver on that yet, but this remains our objective on how to grow EuroDry and provide value for our shareholders. So I'll stop here, and unless Paul has any other direction, I will open the floor for questions, and I will try to find the Q&A button. It should be right here. And start with answering any questions that I see there. And I see the first question there. In a hypothetical Russia-Ukraine peace scenario, how would you expect the grain trade to be affected? If possible, please provide volume and ton-mile estimates. At this point, I would like to leverage the presence of my colleague, Simos Pariaros, on the call. And Simo, if you don't have any, if you don't object, I will pass the question.
Well, sure. I can give some information here. Well, the Russian grain trade has been an extremely important demand driver for shipping. It's the biggest exporter in Europe, and these quantities have not been fully replaced by other sources over the last few years that the war is going on. Ukraine has been exporting some quantities, not in full, not at the levels that they were exporting prior to the war. So overall, on the demand side, my view is that the quantities that will be added from the Russian crop will boost dry bulk demand further. We might see some different dynamics again developing because longer sources were developed over the past few years to cover the needs of countries that were served by the Russian grains. But the quantities of the Russian grain, which have been used historically, are not possible to be replaced by other sources. So overall, the view that we have is that the return of Russian grains into the market will further boost dry bulk business.
Let me move to the next question, and I will try to answer that one. The question is, how much pre-delivery cash outlay do you expect in Q4 and in 2026? Our shipbuilding contracts require us to pay the second installment in the fourth quarter of 2025, and we did that already. So there was an outlay of about 7.2 million for both ships that we did in the fourth quarter. I want to mention here that to increase our flexibility, we have made arrangements to finance through bank loans part of the pre-delivery expenses. So one of the two payments that we made was fully financed by bank debt. The other one we finance ourselves. So this is what happened in Q4. And in 2026, there is between the two ships 3 additional installments because of the different schedules, 2 for the one ship and 1 for the other, totaling approximately about $10.5 to $11 million. Moving to the next question, and Simo, I will pass it to you. How fuel efficient are eco versus non-eco ships?
Well, it depends on the. Let's get a little bit more in detail here. The eco ships have been available to the market since about 2014. So we are well into about 10 years now that eco ships are being used. The first generation of eco ships, which came between 2014 and let's say 2016-17, had an about 20% rough numbers better consumption than the conventional ships at the time. The newer versions of the eco ships and the one that are being designed today have another 20% lower consumption, which means that overall a conventional ship versus an eco ships of the last generation, let's say 2027 build, for example, will have a 40% overall better consumption. Now, if you add in the fact that the ships are a little bit bigger than the conventional ships that were serving the same trades, the actual reduction on a per ton metric would be even more than 40% that it is on the actual ship itself at the moment. So we're talking about a very, very significant drop in operating costs of a modern eco ship versus an older conventional ship.
The next question, which I will start answering, and then perhaps Simon, you can follow on.
Sure.
Why has the market been unseasonably strong for January and in Q1 when rates are usually below break-even? Did something change in the near term? One thing I would say is that the Chinese New Year is sometime in February this year, so people rush to ship before that. That's before they go for 2 weeks off. So that perhaps explains the stronger market in January. I think also the traditional seasonality patterns, some years we have seen that they are not followed. I cannot pinpoint anything specific other than what I just said, but I will let Simos to complement the answer if he has anything else to say.
Not really. What I wanted to add, though, is something a little bit of a more numerical answers in the first question that we received regarding the Russian grain trade. I managed to get a few more detailed numbers that might be needed to mention. The return of Russian and Ukrainian grains into the international market will not be a complete addition to the existing quantities. Russia has been exporting grains during the war years, but to different receivers. Most of the Russian grains are going to countries that have not sanctioned Russia or do not have a problem with the whole war that's going on. So a potential end of the war will change probably the receivers of these grains to longer receiving sources and things like that. But overall, Russia still exports grains, a lot of grains, even during the war years. Just wanted to make this clarification so our the person that had the question had a precise understanding of what is going on. It's not that Russia is not exporting grains today. They are exporting grains. It's just that the war have created dynamics due to the sanctioning of certain trades that have altered the whole export dynamics of the Russian and Ukrainian grains. It's not that these countries do not export at the moment. They do export.
Okay, now we'll try to squeeze the last 3 questions in the next 5 minutes. So we'll try to be more concise to our answers. Do you expect to delever following the delivery of your new ships? What is your optimal debt level in your mind? I think we believe that having a healthy debt level, and I'll say what is the percentage, supports the returns for our shareholders. Currently, as I mentioned, we have about 50% loan to value ratio. We are targeting to finance our 2 new ships with about 60-65%, say 60% on average, and maintaining these levels, 60% for the new ships and 50% declining, I guess, as we repay for the second hand, we consider to be an optimal debt strategy, giving us the flexibility as we repay debt to refinance and increase it if we see opportunities. We did that last year when we refinanced 2 ships. Along with the new building, we refinanced one of our existing ships, and we boost our liquidity a little bit more to be more comfortable and have some firepower to execute any opportunity that we may run. Another quick question. Under which scenario would you restart your buybacks in the open market? Simos, I'm passing this to you.
Sorry, I had a bad connection for a second. Could you please?
Under which scenario would you restart your buybacks in the open market?
Well, it's a decision to be taken in our next board. We continue to believe that our stock price is a hell of an opportunity for the buyback, but we are trying to have a balanced approach. We're seeing the company does not have ample liquidity to use as much as we might want it to use on the buyback, so we have to be a little bit cautious in the sense that we need to maintain a healthy balance sheet and a healthy cash position on the company. We are considering again to restart the buyback, possibly after our board meeting, but this is a decision to be taken during our next board meeting. But overall, we continue to believe that the stock price at the current level presents a hell of an opportunity.
Yeah, at the same time, I would like to add that the liquidity of our stock is relatively low, so we don't have much that we can do anyway.
Yes.
Our buyback program is in full swing. It's not stopped, but it's limited both by the decisions of our board, of course, but also by our ability to execute on that.
Yeah, this is a very valid point, and thank you for making it, Tasso. Indeed, with the current liquidity, it doesn't help us to execute this plan on a scale that makes sense. We need to see a much more liquid stock to be able for us to take advantage of the stock price.
And let me go to the final question. I believe it's the final one. There's one more. What could drive lower break-even rates in order to be profitable in all business cycle? Are there significant efficiencies with scale, like M&As, or lowering debt and interest expense is the best way to achieve that? I think we believe we have a pretty low break-even rate. I think having $11,800 per day break-even rate is low. Obviously, if you had no debt, your break-even rate is even lower. But as I mentioned, we try to create a good balance of returns, reasonable levels of debt, enhance shareholder returns, and we want to follow that approach. If we had a larger company, I think really the only thing that would be affected is the G&A expenses, that you could divide the same number or with a larger number of ships. But I think we are taking pride that we are at relatively quite low break-even rates, I would say. If you have a small fleet like us, it makes a big difference whether in the next 12 months, for example, you have 1, 2, or 6 dry dockings. If you have 6 dry dockings, if half of your fleet has to go through dry dock, then of course that increases your break-even level. If not, it decreases. So that is the situation there. And the final question, EuroDry seems to lack scale to be publicly traded. Do you believe it would be preferable to sell the entity to a big player who is looking for ships given high asset values? It is a continuous evaluation, as I would say, from our side, how to create value for our shareholders. As we are now, we believe we have sufficient flexibility, and I mean, Simos would tell you that 2.5 years ago, I think, Simos, we were able to use our at-the-market offering and sell stock above NAV. So dry bulk is a game, shipping is a game of patience and being there when the opportunity comes. That's part of our strategy for being public. Continuously, we evaluate opportunities, be it in form of M&As, in form of what the questionnaire implies of selling our ships, if it makes sense, to a bigger shop. All of the possibilities that create value for our shareholders. I think we are both out of questions and out of time. So, Paul, I will send the floor back to you.
Yeah, thank you, Tassos, and thank you everyone for taking the time today to join us for your questions. Please note that this webinar will soon be made available for access upon demand on Capital Link's website. As a reminder, that's capitalinkwebinars.com and Capital Link's YouTube channel. Thank you again, everyone. You may now disconnect. Take care.
Let me take a moment to say thank you one more time from the company side. Thank you, Paul.
Thank you. Bye.
Thank you, everybody. Bye-bye.